The Walt Disney Company's stock price has been utterly destroyed, declining over 59% from its 2021 high. It just keeps getting worse and worse. At this point, investors don't want to touch Disney stock with a 10-foot pole. However, outsized negativity like this can often create a buying opportunity, especially when the business just reported a strong Q4 and future cash flow guidance for 2024. Since reporting earnings on November 8th, Disney stock is up over 11%. They are even discussing bringing the dividend payment back soon. I'm officially calling it. The worst is behind us when it comes to Disney stock. The bottom is here. It may finally be time to buy. But first, let's understand what actually happened at Disney to cause this initial decline. To start, the company has become completely politicized. You see it everywhere on social media. It's the crown jewel of the go woke, go broke movement. The political backlash just hit a new height with the release of South Park's Into the Panderverse special. This highlighted the ridiculous nature to which Disney has been pandering in its content with diversity in attempts to include every group. It even specifically called out Disney executives like Bob Iger and Kathleen Kennedy. This pandering at Disney was done with the idea that expanding into new demographic groups would grow their overall audience, hence making more money. A classic business practice. This was on top of incentives like cancel culture, woke activist employees, and questionable developments in corporate America like ESG scores and DEI quotas. This broadly defined wokeness has been rippling through American universities and corporations for a long time. Disney has become a popular example as of late, mostly because they are the leading entertainment company in the world. That means their content, which is seen and loved by millions, was infused with that agenda people dislike. For a while, all the incentives were flowing in one direction. As Charlie Munger says, you show me the incentives and I'll show you the outcome. Soon Disney and nearly every major media company had a heavy focus on diversity, equity, and inclusion in their content. However, there has been obvious backlash mounting. Much of the core audiences for Disney franchises did not enjoy or support the new content. What they described as forced wokeness has taken over. This is at the same time they were making more content than ever with less of a quality standard. That content factory approach was part of the strategy to grow streaming subscribers at any cost. There was a lot of garbage that ruined the perception of some good content. The streaming wars caused media companies to lose billions in an endless attempt at growth. Those streaming losses were the far more significant reason for the Disney stock decline. We'll talk a lot more about that later in our stock analysis. However, the so-called woke backlash is still real. The latest example of this was the Marvels movie, which just released. This is on pace to be the worst performing MCU movie of all time. On the surface level, the cast appears to be the exact example of a movie built around diversity and inclusion first, story second. It's almost funny when you think about it. Really bad timing considering this environment of blowback. The enthusiasm was very low, especially since the movie's main character is unpopular in many circles, there was an actor's strike preventing promotion, and the story was not impactful to the overarching Marvel plot. It's just not what Marvel's core audience wants to see. In the weeks prior, Loki Season 2 came out and it was a big success. Fans loved it, critics enjoyed it, and the series performed well on Disney+. It's not a Marvel problem. It's a content-specific problem. It was so obvious that the Marvels would not be a box office success. There is now a clear financial backlash against overly pushy wokeness in content, whether real or not. The perception is what matters. This is across culture, not just Disney specific. There are countless examples just in the last year, whether it was Bud Light or Target. A negative incentive is now in place. Luckily, Disney CEO Bob Iger has already started moving the company in a new direction. He just recently came out and stated he is working to, quote, quiet the noise in the culture wars. One example of this was the news that they will delay the massively criticized new Snow White movie to 2025. On top of this, they will be conducting reshoots, altering the story, and bringing back dwarfs rather than their planned casting of these weirdos. Good job, Bob Iger. Disney is changing. It's even happening at ESPN. This year, they signed a massive deal to bring the Pat McAfee show to ESPN. That was a much needed shift both culturally and in terms of business model innovation. Pat started independently on YouTube as a daily live show. It has earned a massive organic fan base and reputation of authenticity. It's made by NFL players and fans. It's an internet-native show. The audience is the exact demographic ESPN needs to stay relevant. It's 82% men 18 to 44 across the political spectrum. It does great in the middle of the country, among young people and conservatives, which ESPN has been losing over the past decade. There is no wokeness, no politics. It's just having fun, talking sports, and making locker room jokes. It's how real people talk. The Pat McAfee Show is the first fully cross-platform program at ESPN. It's available live on cable, ESPN Plus, and YouTube. It's a juggernaut on digital platforms. This strategy is the future of ESPN commentary. I suspect they will continue partnering with successful internet shows and podcasts. Despite wokeness being the main narrative online around Disney stock, that is not the main factor in its price decline. In reality, it's all about the money. Politicization is just a small, indirectly related factor in that equation. Disney has been facing major business model disruption from the decline of cable television. While their new streaming business is growing, it's wildly unprofitable. It has shown to be a money fire pit. Many investors were not sure if it could ever be profitable. Given the uncertainty, it's pretty obvious why the stock price declined. At its peak last year, Disney streaming services were losing $1.4 billion a quarter. This killed the company's overall profitability and cash flow. They were spending like maniacs throughout their entire business. Since Bob Iger came back in late 2022, Disney has been changing for the better. The business is focused on cost-cutting, profitable growth, reducing content output, and improving the focus and quality of each production. They are resetting the expectation. For example, Marvel will only be releasing one movie in 2024, Deadpool 3. This will likely be a smash hit. The next Captain America movie has been delayed to 2025 with reshoots and changes underway. Profitability and quality is now the core focus. This is already starting to be reflected in Q4 earnings and their 2024 guidance. Bob Iger is not only turning Disney around, but building a real cash-generating growth business. In today's video, I will analyze Disney stock from the perspective of a long-term investor. This will include a deep dive into Q4 earnings and a discussion of all the important business news. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using the stock research tool I personally developed, which is available at dividenddata.com. Here you can do deep financial analysis on over 7,500 stocks, helping you find better investments. Link in the description and pinned comment. 2023 Q4 was the best quarter Disney has had in a long time. The company flexed its profitability muscle and made clear progress on its growth initiatives. In the quarter, Disney generated $3.42 billion in free cash flow. That is the best individual quarter since 2018, which was before the pandemic disruption and the launch of Disney+. In fact, this is one of their best financial quarters of all time. It brought Disney free cash flow for the full year 2023 to $4.9 billion. However, the best part is their 2024 guidance. Disney is projecting to generate $8 billion of annual free cash flow in 2024. This will get the company close to their prior all-time high of $8 to $9 billion. With this cash flow, Disney is in a position of financial strength. They can pay off debt, buy back shares, and bring back the dividend. All of this is great for investors. In fact, Bob Iger has stated that his management team is recommending that the board approve a modest dividend by the end of the calendar year. Pending approval, Disney will restart its historic dividend. The intention is to continue growing it from there. I would expect financial responsibility and a shareholder focus moving forward. This is highlighted by the the recent hire of PepsiCo's longtime CFO, Hugh Johnston. He will be the new Disney CFO. At PepsiCo, he led the company to growth while rewarding shareholders with growing dividends and buybacks. PepsiCo is the dividend king. The best part is that Disney is aiming for continued growth beyond that $8 billion range in the following years. In fact, Disney Plus and their overall direct-to-consumer streaming business is only projected to just start becoming profitable in 2024. There is so much more room for growth beyond this. That may just be the start. For context, the best and most mature pure streaming service, Netflix, has proven it can generate serious profits. As of late, Netflix has been generating between $1 to $2 billion of free cash flow a quarter. This is from just a streaming service. That is only going to grow with continued price increases and subscriber growth. Disney Plus, Hulu, and ESPN Plus can and will become a profitable growth business for Disney. This is on top of their diversified media empire. Disney has the best parks business in the world. They own some of the most valuable intellectual property, whether it's Marvel, Star Wars, or countless others. Beyond content and theme parks, they are monetized through consumer products and licensing. ESPN is the best and most profitable sports media asset in the world. Disney really has a strong foundation to work from. So how has Disney turned around their cash flow so quickly in 2023? Well, they actually just prioritized it and tried. Shocking. The company was initially targeting $5.5 billion in annual cost savings. This quarter, they upped that target to $7.5 billion in annualized cost savings. Frankly, the company was spending like drunken sailors. They switched the philosophy of their streaming business from growth at all costs to profitable growth. Disney realized they don't need to feed the streaming beast with endless content. They already have a massive library with decades of iconic content they can lean on. In reality, they only need to add a few quality releases at a time, not endless junk, at least with their core franchises. Disney is making less content, spending less on what they make, and trying to focus on improving quality. On top of this, they are raising prices for their streaming services and building a cheaper advertising-based tier. This combination helped erase Disney's streaming losses. In Q4 2023, losses were brought down to $400 million. That's a $1 billion reduction of quarterly losses in just 1 year. That has a giant impact on the bottom line. On top of this, the company grew core Disney Plus subscribers by 7 million in the latest quarter. That is massive and blew past expectations. It was driven by the performance of 3 movies hitting Disney Plus in that time: Guardians of the Galaxy 3, which was awesome, Elemental, and The Little Mermaid. They all topped the streaming charts and performed great. It really shows what a significant second life these movies can have after theaters on the service. It's a great opportunity to double dip. On top of this, they released Star Wars Ahsoka, which was great and performed strongly. These titles led to the best growth seen in quite a few quarters. Raising prices, cutting costs, and growing subscribers is a fantastic position for Disney Plus to be in. In fact, the company just had another wave of price increases, which was not even reflected in the latest quarter. They raised prices on the ad-free plan by another 27% while keeping the ad plan at the same low entry price. This, combined with another wave of cost cuts, will only help Disney Plus and the direct-to-consumer segment reach profitability in 2024. It's going to happen. In the upcoming quarter, the latest released Loki Season 2 will be included along with their upcoming holiday releases. I suspect this will only continue some subscriber growth even with the price increases. In related news, Disney is finally purchasing the remaining 1/3 ownership stake in Hulu from Comcast per their prior agreement. Disney is planning to pay $8.61 billion, which was the agreed upon floor price at the 2019 deal. However, that will be analyzed by an agreed upon third party to determine the fair valuation, so it could be more. Personally, I think the current value is fair given how much the valuation on streaming companies have compressed since 2019. That was bull market time. The comps are just not there. The max I see it going for is in the $12 billion range. This will give Disney full ownership of Hulu and allow them to further integrate it into Disney Plus. The Disney bundle is very powerful and the best deal in streaming. Disney is now planning to make a one-app experience available, putting all the content together. Bob Iger discussed this and the latest performance of the streaming business in his recent post-earnings interview on CNBC.
I'm joined now by Disney CEO Bob Iger. Thanks so much for joining me to talk about these results.
Thanks. Nice to see you, Julia.
It's great to be here. So I want to start off with the direct-to-consumer business. You reiterated that you're on track to hit profitability as planned, but a big beat on subscribers. You also recently just raised prices. And I'm wondering if you expect that subscriber growth to be able to continue.
Well, we do expect subscriber growth to continue, but we're mostly focused now on delivering profitability by the end of fiscal 24. We had a great quarter, as you just noted, adding 7 million core Disney Plus subs. That was really the result of great content, particularly 3 strong movies, Guardians of the Galaxy 3, Elemental, and Little Mermaid. Disney Plus is proving to be extremely popular and in demand, and we feel very bullish about its future.
So what does the future of your streaming bundle look like, especially given the fact that you're about to, or you're in the process of buying out the remainder of Hulu that Comcast, CNBC's parent company, currently owns? And how much do you expect to have to pay over that base level that you already negotiated for that remainder of Hulu?
Well, first of all, as you know, there's a floor price, which is obviously public, stated. We'll be writing them a check for that actually pretty soon. There will be an evaluation process that is dictated by the agreement that we reached with them a few years ago. I'm not going to say much more about that process, except, we expect it will be fair and ultimately objective, and we're not concerned about the price that we will end up paying. It's a great step for the company from a strategic perspective in that it gives us an opportunity to further connect the dots between Disney Plus and Hulu and ultimately offer even a 3-play or a triple bundle with ESPN. There's 3 great sets of streaming assets. And in December, we will launch in beta form a combined Disney Plus and Hulu app. And then in sometime, probably in late March of calendar 24, excuse me, it'll launch basically out of beta. We feel great about it because the combination will give us an ability to essentially lower customer acquisition costs, reduce marketing, hopefully reduce churn, and most importantly, create more engagement. And that's great for advertising. As you know, we have advertiser-supported subscriptions for both Disney Plus and Hulu. Actually, it's quite a bargain. You'll be able to, if you're a Disney Plus subscriber, you'll be able to upsell to Hulu for $2 more with advertising and vice versa for Disney Plus. So this is all a great step for us.
Disney's entertainment business segment is improving. Despite it being their highest revenue segment, it's their least profitable. Once again, thank the streaming losses for that. Direct-to-consumer Q4 revenue grew 12% year over year. Operating income increased by 70% while still a loss. Linear networks are suffering from the decline of the cable bundle. However, it is still a cash cow, and operating cash flow remained flat at $805 million. We need to remember, though, Disney is a diversified media company. Bob Iger just officially reorganized the business, moving their reporting categories into 3 segments. We now have entertainment, sports, and experiences. We just discussed entertainment, now let's take a look at sports. For the first time ever, we see ESPN's financials brought out by themselves. Frankly, it showed how profitable that business really is. Revenue is flat for Q4 year over year, but operating income is up 14%. ESPN nearly made $1 billion profit in the quarter. Despite cable being its core profit center, ESPN is not seeing an overall financial decline in the business. It is the #1 cable asset and commands the highest subscription price and advertising rates. However, the decline of the cable bundle subscribers is a massive headwind for ESPN. It will remain highly profitable, but for future growth, they will need to grow into digital. They have ESPN Plus, which has 26 million subscribers. However, that is not the full ESPN product. It's missing much of live programming and often doesn't even get Monday Night Football. This is because Disney has been keeping some content cable exclusive so they can continue to command high margins. That said, Disney is planning on the fully digital future of ESPN. In the next few years, they will launch a full package ESPN streaming service. This would include all the live TV content not available on the current ESPN Plus offering. They may even partner with other media companies to beef up the offering with more sports rights. That is why they are looking for a strategic partner. Rumors include tech companies like Apple and Amazon, sports leagues like the NFL and NBA, or other media companies with sports rights. Bob Iger discusses the recent business performance of ESPN and the streaming service launch in the following clip.
You mentioned that ESPN was up in the quarter and thus up in the fiscal year. Is actually up in operating income and and in revenue in 22 and in 23. So great trajectory. And the ratings are actually very strong, too. ESPN had one of the strongest years ratings-wise, I think, in the last 4 or 5 years in 23. That's a great thing. We obviously are planning to take ESPN out on a direct-to-consumer basis. We feel great about that. We believe we have an opportunity to strengthen that hand even more by bringing in 1 or 2 strategic partners that can add either marketing support, technology support, or possibly content support. Why not go out with a stronger hand, for instance? And that's what we've been considering. We've been in discussions with a number of entities. I don't have anything specific to tell you right now, except I think you can expect us to elaborate more on that sometime in the near future.
So there's been an expectation that this direct-to-consumer version of the flagship product will launch by 2025. Is that right?
We've not said specifically what date. We were targeting 2025. It won't be long. It won't be later than that. And again, we're working hard to make sure that we've got the building blocks in place to see to it that when we bring it out direct to consumer, that it is very successful. And we feel great about that, but we have an opportunity to consider some strategic partnerships that I think will make the transition even more successful.
The NBA rights are the next sports rights that are up for grabs. How essential is it for ESPN to have those rights? And how problematic is it that you have these big tech companies pushing up the prices?
Well, I'm not going to comment about the negotiation at all, except to say I've said before, the NBA is very important to ESPN, has been for a long time. I should note that ESPN is important to the NBA, too. We bring to not just the NBA, but to other sports organizations a level of support, engagement with audiences, not just on linear television, but in podcasts, on radio, and online and in apps, and I could go on. That's quite valuable to these sports organizations, and I don't think that should be discounted.
The reason why Disney has been cautious with launching this flagship ESPN streaming service is because they believe it would be a major force in accelerating the decline of the cable bundle. Given that's the current main profit source, it is important to time the transition correct. As Iger mentioned in the clip, they are also considering strategic relationships to strengthen the product offering. The goal is to make ESPN the premier sports streaming service. They have a really good shot, especially when you consider the bundling economics with their other services. Other developments in ESPN include the recent launch of ESPN Bet, which is a gambling partnership with Penn Entertainment. ESPN is licensing their brand for $1.5 billion in cash over 10 years. They also got $500 million in Penn stock warrants. This is a no-risk win for ESPN. That said, I do think ESPN Bet actually has a real shot to be a successful player in the gambling space. Finally, we'll look at Disney's third and most profitable business segment, experiences. This includes their parks and consumer products. These are performing great. Overall, the segment is up 13% in Q4 revenue year over year and up 31% in operating income year over year. This is due to the full recovery of their international parks business. Domestic parks continued growth even from the strong 2022 base. Parks is the real moneymaker of Disney. It's where they bring all their iconic brands to life in the real world. The monetization opportunity here is really impressive and unmatched among media companies. The only downside with the parks business is that it requires far more capital investment than a pure tech or media business. This is because it's a real-world construction and engineering project. They also have to uphold a bar of quality and safety, so maintenance is very important. Disney just announced they are planning to invest $60 billion over the next decade into their parks business. In the following clip, Bob Iger explains why they're making that investment and the overall strength of Disney parks.
Well, if you look at our track record, particularly the last 5 years of the parks, but you could look back another 10 years, it's been stellar in terms of return on invested capital. The investments that we've made in that business, just by the way, and domestically, but also globally, have really paid off. And they've each paid for themselves in many ways. And since we make decisions about it, capital allocation that are based on what we feel is the best way to deploy our money to deliver shareholder value, we felt in looking at the results of the parks that since the returns have been so strong, why not invest more? It was as simple as that. The trajectory is very bright for those parks. You can look at the results today and see that not only are domestic parks doing well, although we've got some difficult comparable or comparisons in terms of the Florida parks, but the international parks are doing extremely well, as is our cruise business. So when we looked ahead at how we'll allocate capital, and you mentioned the guidance that we gave about growing free cash flow in fiscal 24, we decided that a great place to place our bets or our capital is in the business that's delivered the best results.
I am a big believer in parks and think that it's a core growth business for Disney. It is their most reliable and growing source of cash flow. Demand is consistently high with strong pricing power. This leads me to believe there is a lot of room for expansion over a very long time. Overall, the Walt Disney Company is improving their financial performance. 2023 Q4 revenue was up 5% year over year. Q4 free cash flow was $3.428 billion, which was over a 100% increase year over year. For the full year 2023, revenue was $88.89 billion, which is a 7% increase year over year. Free cash flow for 2023 was $4.897 billion, which is over a $3.8 billion increase year over year. This growth is only set to continue. Disney has issued forward guidance expecting to grow free cash flow in fiscal 2024 significantly, approaching levels not seen since pre-pandemic. That means on the conservative end, annual free cash flow for 2024 will be around $8 billion. So what does this mean for the value of Disney's stock? At current prices, Disney is trading at $172 billion. So the company is valued at 21.5 times 2024 free cash flow. You can make the argument that makes the stock fair value and that's not trading at a discount. However, it's very likely free cash flow grows far beyond that level. Streaming is only just starting to reach profitability in 2024. If it ever reaches Netflix levels, then it's not unrealistic that the business could generate $15 billion and more in annual free cash flow. Bob Iger has extended his contract as Disney CEO through 2026. I expect that the company will be hitting all-time highs across every financial metric by the time he leaves. By then, the stock price will likely be at all-time highs as well. The decline of Disney stock is over. Iger has reoriented the company towards a focus on profitability. Free cash flows are growing. With this, they will strengthen their balance sheet and pay down debt. Currently, they have $14.1 billion in cash on hand. This will decline in the short term due to the Hulu acquisition I mentioned earlier in the video. The company has paid down debt going from a peak of $64.4 billion to $46.4 billion as of Q4. This will continue, especially with the increased cash flow. That new cash flow will be used to reward shareholders. I expect in 2024, we will see a return of the Disney dividend and the start of share repurchases at some point. I own Disney stock in my long-term dividend portfolio, but it was one of my worst investments ever. Even with the latest increase, I'm down over 32%. I learned a huge lesson about chasing stocks at high prices when the underlying financials were not yet there. However, the Disney financials are now improving. I expect 2024 and the following years will be strong for Disney stock. However, that's just my opinion, so be sure to do your own research before making any investment decisions. Please leave a like, share, and subscribe to the channel if this video provided value. Sign up for dividenddata.com if you want to use the research tool I've been showing throughout. If the software helps you identify just one slightly better stock, then it pays for itself. Here you also gain access to my portfolio tracker, which provides unique insights for the dividend-focused investor. Thanks for watching.